Hey guys, Josh here with 1215 Day Trading, and in this video I'm going to be showing you how you can turn your losing positions that you are holding right now inside your taxable account into a tax payday so that when it comes tax time, you can put some money back into your pocket. But before I begin, please note that I am not a licensed CPA or advisor. Everything I mention in this video is for general explanations and education. So before acting on anything that you hear or see in this video, please consult with your tax, legal, or investment advisor. All right, so let's get into how you can turn your losing positions into a payday once it comes tax time. So let's say that you are holding a long-term position in the ETF VOO. Now, this is a very popular ETF that many people own since it mimics the performance of the S&P 500 index. And as you can see here, the performance of both the S&P 500 and VOO are the same, and this is because the underlying index of VOO is the S&P 500, okay? So holding a position in VOO is the same thing as holding a position in the S&P 500. And this is one of a few great long-term investments to buy and hold forever because the major indexes such as the S&P 500, the Dow Jones, and the NASDAQ are highly likely to appreciate over time, just like they have been over the past 100 years. Now, of course, over the past 100 years, there's been some pretty bad years, but over time, things have always worked themselves out to where the indexes eventually continue to make record highs. So investing in the major indexes is a pretty safe choice when investing in something for life. So let's say that you buy $10,000 worth of VOO, but some type of economic event happens that causes VOO to drop 30% in value, and now you are holding a position worth $7,000. So on paper, you have taken a $3,000 loss, but this loss isn't real until you sell. Now, a common misconception that a lot of people have when it comes to long-term investing is that they should never sell, but only add to losing positions through dollar cost averaging. And while that's good advice for long-term index fund investing, it's not the best advice, or should I say complete advice, because this trick that I'm about to show you is going to help you actually make money selling the losing position while still theoretically holding the position, so then you can continue to dollar cost average into it. So let me show you what I mean by this. Going back to our example here, we paid $10,000 for VOO, but the position drops 30% to where it's now worth $7,000. So instead of continuing to hold the position and add to it, what we can do instead is sell the position to realize the loss, because the IRS allows you to deduct capital losses from your stock market investment accounts. So if you paid $10,000 for VOO and the position is at $7,000 and you sold, you just lost $3,000. So this automatically gives you a $3,000 tax deduction, saving you money and putting some back into your pocket when it comes tax time. Okay, but here's the thing that not many people know about or fully understand. And there are rules to doing this, so make sure that you stay to the end so that you're aware of them. After you sell VOO, what you can do is immediately buy an ETF that almost mimics the same price fluctuations as VOO, so it's like you are still holding the original position. All right, so let me show you here. Let's say once you sell VOO, you immediately buy the ETF SCHX. Now, SCHX is another ETF that tracks a major index, but instead of it mimicking the performance of the S&P 500, it mimics the performance of the Dow Jones. And as you see, the underlying index on this one is the Dow Jones US Total Stock Market Large Cap Index. Now, when you look at the price fluctuations of these two ETFs side by side, they are identical. So they essentially behave in the same way. So if you bought $10,000 worth of VOO and it drops in value to $7,000 and you sold $7,000 worth of VOO and then immediately bought $7,000 worth of SCHX, it's almost like you were holding the same position. But because you sold VOO, in the eyes of the IRS, you took a $3,000 loss. But as far as your account balance and performance goes, it hasn't really changed. Okay. What this strategy is called is tax loss harvesting. It allows you to sell investments at a loss in order to offset any gains that you have made on other investments you have sold for a profit, or on any income that you have made, thereby reducing your tax bill. But the trick is you have to replace it with something that behaves the same way before dollar cost averaging, so that you can write off these losses come tax time and still theoretically be holding the same position. Now, there are a few rules that you need to be aware of when doing this. So as a reminder, please speak to a licensed CPA, because this does take a little bit of planning and you need to make sure that you are doing the best thing in light of your personal situation. Everybody's personal finances are completely unique, so be sure that you consult with someone so that you are deploying the best strategy that's right for you. Now, the first rule is that you can only do this inside taxable brokerage accounts. This does not apply to retirement accounts such as IRAs or 401ks, because those are tax deferred accounts, meaning you don't pay taxes on the gains that you make until a later date. But inside a normal taxable account, you do pay taxes every year on any dividends you receive or any gains that you made from selling a position for a profit. So since you do pay taxes in a taxable account, you are able to use the tax loss harvesting strategy in order to reduce your tax bill. The second rule that you need to be aware of is the wash sale rule. The IRS prohibits investors from writing off investment losses if they have sold an investment for a loss and replaced it with an identical or substantially identical investment 30 days before or after the sale. So let me explain what this means. If you bought VOO and it drops 30% and you sold VOO for a loss, and then 1 minute later turned around and bought VOO again, you just created a wash sale because you bought and sold an identical security within that 30-day window. And because of this wash sale, you cannot deduct the $3,000 loss on your taxes. If you wanted to buy VOO again, you would have to wait 31 days after the sale in order to avoid the wash sale. Now, let me show you another example. If you sold VOO for a loss and then immediately bought the ETF SPY, which is another ETF that tracks the S&P 500, you just created a wash sale because you bought and sold a substantially identical investment within that 30-day window. Now, this is what substantially identical means. Two ETFs can be substantially identical if they have the same underlying securities or the same management style. So in the case of switching out VOO for SPY, even though VOO and SPY are two separate ETFs, they are substantially identical because they are both ETFs whose underlying index is the S&P 500. So to avoid triggering a wash sale, you would have to buy a completely different ETF that has a completely different underlying index. So instead, if you sold VOO and immediately purchased SCHX, you can avoid the wash sale because SCHX tracks a completely different index. But here's the trick behind this. Even though these are two different ETFs with two different underlying indexes, the price fluctuations for both are essentially the same. The IRS doesn't say that you cannot buy a security that has similar price movement. They only say that you can't buy the exact same security or similar security that has the same underlying stock holdings or management style. VOO and SCHX are completely different in those categories. So when you are investing in ETFs and you want to take advantage of tax loss harvesting, it's important to figure out pairs of ETFs that are different but behave more or less in the same way as far as price movement goes, so that you can take full advantage of this. So you might have a few primary ETFs that you invest in, and then once you see all or one of these go into the red a pretty large amount, you can sell the position to capture the loss so you can deduct it on your taxes and then switch it out for a secondary ETF. All right. The third rule that you need to be aware of is that the IRS only allows you to deduct up to $3,000 in capital losses per year. And if you have more than $3,000 in capital losses, the excess will be carried over into future years. So let's say in year one, you sell for a total of $7,000 in losses. Well, in that year, you are only able to deduct $3,000, in which the remaining $4,000 will be carried into the next year, in which you'll be able to deduct another $3,000, and then the remaining $1,000 can be deducted in year three. So as you can see, the losses keep getting carried over, being reduced by $3,000 until the full amount has been deducted. Now, something else that you need to be aware of is that tax loss harvesting does not completely eliminate paying taxes. It only postpones paying taxes by giving you a tax break now, but possibly paying taxes later. So let me show you. If we bought VOO and it drops 30% and we sold for $7,000, we write off the $3,000 and then purchase SCHX. But if the market turns around and our new SCHX position climbs 100% and we sold everything for $14,000, we would now owe taxes on the $7,000 that we made. So if you plan to sell the entire position once it reaches a substantial profit, tax loss harvesting isn't really going to benefit you in the long run. So this is why the tax loss harvesting strategy really works best when you plan on staying invested for life, to where one day you can use your portfolio to provide all your income needs just through dividends, and you never really have to touch the principal. So if this is your goal, tax loss harvesting inside a taxable account can really help you. Another thing that you need to be careful of when tax loss harvesting is paying attention to your dividend payout dates, because these could potentially trigger a wash sale if you do not time your tax loss harvesting strategy correctly. What a lot of people do in their long-term investment accounts is tell their broker to automatically reinvest the dividends. So when a security pays a dividend, it automatically gets reinvested by buying fractional shares in that amount of the dividend. But this could be troublesome for tax loss harvesting, as it could potentially trigger a wash sale. For example, if you sold VOO on March 25th and then 5 days later it pays a 0.5% dividend, and you have your broker set to automatically reinvest this dividend payout for you, it's going to automatically buy 0.5% worth of shares and therefore trigger a wash sale in which you cannot deduct the amount you sold for a loss on VOO. So this is why I don't personally have my broker automatically reinvest the dividends for me, so that I can reinvest them manually through more careful planning. Okay. So that is how you use tax loss harvesting to turn your losses into a tax payday. And as a reminder, please speak to a licensed CPA before doing this, because this does take careful planning, and you want to make sure that you are saving the most money and also deploying the best strategy for you. I hope you all learned something, and I'd like to thank you so much for watching.